Imagine sending money across borders and then waiting for banks, cutoffs, and intermediaries to agree that it really arrived. XRP is often described as a fast settlement asset, but that raises a simple question. What is actually settling, who confirms it, and where does Ripple's RLUSD stablecoin fit? The first thing to separate is XRP and the XRP Ledger. XRP is the native digital asset. The XRP Ledger, often called XRPL, is the blockchain network where XRP transactions are recorded. Ripple is a company that builds payment and crypto infrastructure around this ecosystem. Ripple did not mean the same thing as XRP, even though the names have been mixed together for years. The big problem XRP was designed around is not memes, games, or general-purpose apps. It was designed around moving value quickly, especially when two parties do not share the same currency or banking rail. Settlement means the transfer is final enough that both sides can treat it as done. In traditional finance, messages can move quickly, while actual settlement still takes longer behind the scenes. Think of a payment message as a receipt saying money should move. Settlement is the actual balance change that everyone accepts. XRPL tries to make that balance change happen directly on the ledger. On the XRP ledger, new ledger versions are validated in a few seconds under normal conditions. Once a transaction is in a validated ledger, the design treats that result as final. This is very different from Bitcoin. Bitcoin uses proof of work, where miners spend energy competing to add blocks. XRPL does not use mining and does not create new XRP as block rewards. It is also different from proof of stake networks. XRPL validators are not selected because they locked up the most coins, and they do not earn staking yields from normal validation. Instead, XRPL uses a consensus process. Validators share proposed transactions, compare results, and keep narrowing toward the same next ledger until enough trusted validators agree. A validator is a server configured to participate in consensus. It checks transactions, follows the protocol rules, and helps decide which transactions belong in the next validated ledger. Each XRPL server listens to a chosen set of validators called a unique node list. The idea is not to trust one central party, but to choose validators that are unlikely to collude. For the network to stay together, these trusted lists need strong overlap. If different groups listen to completely different validators, they could risk disagreeing about the valid ledger. In practice, many operators use recommended validator lists to make that overlap easier. This improves coordination, but it also creates a trade-off, because list publishers become important pieces of social infrastructure. This is one of XRPL's key compromises. It can settle quickly because it avoids open mining competition, but it depends on the quality, diversity, and independence of the validators people choose to trust. If this kind of plain English crypto breakdown is useful, consider subscribing. We keep the focus on mechanisms, trade-offs, and what is actually happening under the hood. Every XRPL transaction includes a small XRP cost. That cost is not paid to a miner or validator. It is destroyed, which helps discourage spam without creating a fee income race. This is why XRP matters inside the system, even when the user is moving another asset. XRP is the native asset used for transaction costs and account reserves on the ledger. An XRPL account must hold a minimum amount of XRP to exist on the shared ledger. Extra ledger objects like offers or trust lines can also require reserve capacity. The reserve system is not meant to be a normal spending fee. It is a way to make unlimited account creation and ledger clutter more expensive for attackers. XRP can also be used as a bridge asset. If one market has liquidity between dollars and XRP, and another has liquidity between XRP and euros, XRP can connect the path. XRPL has built-in tools for cross-currency payments. A payment can search through order books and liquidity sources to find a route that delivers the desired asset to the receiver. Unlike many chains where trading depends entirely on smart contracts, XRPL has native exchange features at the protocol level. Offers and liquidity pools can exist directly in ledger logic. That makes XRPL feel less like Ethereum. Ethereum is a broad smart contract platform. XRPL is more specialized, with many payment and exchange functions built into the base system. Specialization can make common financial operations simpler and cheaper. The trade-off is that developers may have less freedom than on a general smart contract chain, where almost any program can be deployed. For a simple XRP payment, the sender signs a transaction with their private key. The transaction enters the network, validators agree on the next ledger, and the receiver's XRP balance updates. If you self-custody XRP, you control the keys that authorize spending from your address. The ledger stores balances and transaction history. Your wallet software helps you sign and submit instructions. The main user-level risks are familiar. You can sign the wrong transaction, send to the wrong address, lose your keys, trust a bad wallet, or use a custodial exchange that controls access for you. On exchanges, XRP deposits often use a destination tag. The exchange may control one big wallet, and the tag tells them which customer account should get credit internally. A common misunderstanding is that XRP gives you a claim on a bank or on Ripple. It does not. Native XRP is an asset on the ledger, not a promise to redeem dollars. Issued tokens on XRPL are different. A dollar token, for example, usually represents someone's promise that it can be redeemed for real dollars somewhere off-chain. To hold many issued tokens on XRPL, users create trust lines. A trust line says that your account is willing to hold a token from a particular issuer, up to a chosen limit. Trust lines make the hidden counterparty relationship visible. You are not just holding generic dollars. You are holding a specific issuer's dollar token, with that issuer's rules and risks. Another important distinction is freezing. XRP itself is not an issued token on XRPL. Issuers may have controls over tokens they issue, but those controls are not the same as freezing native XRP. This is where RLUSD fits. RLUSD is Ripple's US dollar-backed stablecoin. It is designed to represent a dollar on-chain while moving through blockchain settlement rails. A fiat-backed stablecoin depends on reserves and redemption. The basic promise is that each token is backed by assets such as cash and short-term cash equivalents, and can be redeemed according to issuer rules. RLUSD is issued on the XRP Ledger and Ethereum. That matters because the same stablecoin brand can move in different ecosystems with different fees, wallets, applications, and settlement experiences. XRP and RLUSD solve different problems. XRP is native, has no issuer, and can move as a bridge asset. RLUSD targets dollar stability, but it relies on an issuer and reserve system. In a payment flow, a business might prefer RLUSD when it wants dollar value without crypto price movement. XRP might still matter for network fees, liquidity paths, or bridging between assets. If someone holds XRP during a transfer, they are exposed to XRP's market price for that time. Fast settlement reduces that window, but it does not erase market risk or liquidity risk. A bridge asset is only useful when there is enough liquidity at both ends. Speed alone does not guarantee a good exchange rate, especially for large transfers or thin markets. Another beginner trap is assuming every Ripple partnership means XRP is being used. A company can use Ripple technology, stablecoins, or fiat rails without necessarily using XRP in every payment. XRP was created at the start of the ledger rather than mined over time. A large portion was allocated to the company now known as Ripple, which remains an important topic in decentralization debates. Because there are no mining rewards, XRPL does not issue new XRP to pay validators. The supply mechanics are very different from networks that continuously mint new coins for security. So why run a validator? Usually because an operator benefits from a reliable network. wants independent verification, supports the ecosystem, or provides infrastructure. It is more public utility than yield farm. Protocol changes happen through an amendment process. Validators can signal support for changes, and the network only activates them when the required level of support is maintained. The fairest way to describe XRPL is not fully centralized and not identical to Bitcoin decentralization. Its decentralization depends on open software, many independent participants, and how validator trust is coordinated. Compared with Solana, XRPL is not mainly trying to be a high-throughput home for every consumer app. Its identity is closer to payment settlement, issued assets, exchange functions, and institutional-style rails. Compared with Bitcoin, XRPL sacrifices proof-of-work's very simple trust model for speed and efficiency. Bitcoin asks you to trust accumulated work. XRPL asks you to rely on validator consensus. Compared with Ethereum, XRPL is less about universal computation and more about built-in financial primitives. That can reduce complexity for some payments, but it can limit composability for some applications. For beginners, the main risks are validator trust assumptions, Ripple's ecosystem influence, regulatory uncertainty, issuer risk for stablecoins, liquidity limits, wallet mistakes, and the normal volatility of crypto markets. People still talk about XRP because it represents a different blockchain design choice. It asks whether settlement can be fast, low cost, and useful for payments without mining or broad smart contract complexity. If you want to follow up, leave a comment with the part that still feels unclear. We can cover RLUSD deeper, validator lists, trust lines, or how XRP compares with Stellar next.